The Fed takeaway is that it was July 31st before the August 1st announcement of new tariffs on imports from China. And I think that the impulse not to raise and to wait and see is going to go flip over to the other side. We actually see another rate cut in September precisely because of the uncertainty that is caused by the tariffs. And we don't see that going away anytime soon.
So you're positive. You don't think there's a recession. How do you explain the yield curve inversion?
I just don't think the bond market is omniscient, that it is all seeing, has some ability to predict recessions that nobody else has. We were hearing this in the fourth quarter, Sarah. I was hearing a lot about inverted yield curves in the fourth quarter, and we're up 17% from there. So I just don't lose a lot of sleep on it. I think, frankly, long-term yields are way too low right now. Nobody should buy a 10-year bond at 1.6%. You're going to get a negative return after inflation, let alone taxes. So the long end of the curve needs to go up.
So, Alicia, is it different this time in terms of how we should view an inverted yield curve, even if it took place for only a short time, although it may take place again?
So it's really a great question because, in a sense, the inversion is due to technical reasons in the global bond market. We're up to $16 trillion worth of negative yielding debt. And where else are you going to go except for the U.S. market? So we have all these flows pushing down yields. Nevertheless, the question remains, even if it's a technical signal, does the Fed have to react anyway? Meaning, does the inversion itself on the 310 signal that the Fed's too tight? And we think it probably does signal that the Fed's too tight here, even though there are very good technical reasons why we've inverted.
You don't agree with that at all?
No, I apologize. That is the general consensus. I agree. But we're staring at trillion-dollar deficits. We are staring at lots of things that are going to produce inflation. We are at higher wages, tight labor markets, a president who's trying to talk down the dollar. We have a lot of things that are potentially dangerous for inflation. And the last number, ex food and energy, was up more than 2%. So I do not think, as a matter of policy, this is a good time to cut rates.
You didn't even mention tariffs.
Well, right. Tariffs are going to add to prices. That's exactly a good point,
I just wanted to give you another one.
There's a long list.
And yet, everyone's been saying this for a long time.
But we're at 2.2. When you say we haven't seen it, ex-food and energy, we are over 2% right now. Have you paid for a college tuition? Have you paid medical bills? Have you paid rent in New York City? All of those things are going up much faster than 2%.
Well, they have.
They have.
New York City, I think, are not going up now any faster, but they have. College tuition never stops going up.
And
that's a conversation for another day.
Too.
Negative rates going to persist in the rest of the world to the extent they are? Is there a way out if you're the ECB at this point? Because it seems to be pushing on an open door.
Yeah, the ECB is pushing on a string. We thought that the sounds of fiscal stimulus coming from Germany would be a great first step in reversing this cycle, because I don't think there's an easy way to get out of this. I mean, what we've seen is that negative rates neither stimulate the economy. They misprice assets. You've got zombie companies all over Europe because the debt simply doesn't default because the ECB is buying it. So it just really doesn't help the real economy in any sense.
Yeah, but to the extent that 90% of all yielding instruments, with things that have an integer in front of them, are in this country, aren't we going to continue to see those flows that continue to have that pressure on bonds?
That's right. So that's why we think that for investors that you should be well diversified, so not just equities, but in the bond market as well, because that pressure is going to remain in the U.S. market, and we could see yields going lower here.
So, Charlie, what's the strategy on equities?
So if we think equities are a lot better buy than bonds, we think, frankly, there are no good values in long-term bonds. If you're buying any bond more than maturity of more than 3 or 4 years, you're getting a negative return after inflation. If you are afraid of the stock market, and we don't think you should be, it is much better. You should put your money in cash. You could even consider gold, but do not put your money.
You weren't rushing into 30-year German debt
at a 0% yield.
Yeah.
At a 0% yield, which didn't sell, by the way. That auction failed. And that is a sign that people are not going to accept negative returns forever.
Is it cyclical stocks that you like?
They're the cheapest. So right now, what people are overpaying for are the safety stocks, the bond equivalents, the utilities, the REITs, the high dividend paying pharmaceutical companies. What's cheap is everybody's afraid of recessions. And so industrials and some consumer discretionary stocks are what's a good value right now.